This is your macroeconomics video on the tax multiplier. In the last video, we talked about the spending multiplier, which is basically a new injection of money being spent in the economy, which of course gets spent multiple times and creates a multiplier effect. You can also get the same effect by reducing taxes. When the government lowers your taxes or a business's taxes, it means that a household has more of their own take-home pay or income to spend. Tax multipliers differ based upon what type of tax cut it is. For example, sometimes the government cuts our taxes by literally giving us money. So they did this during the pandemic. They do this during recessions where they just send you, let's say, $500 or $2,000, and then you can spend it. It's kind of a tax rebate. They're giving you some of your tax money back. Sometimes Congress passes a bill to literally lower the percentage of taxes that you pay on income or business profits. Households and businesses also spend tax cuts differently dependent upon whether they think or perceive that it is a permanent tax cut or a one-time thing. So if you're going to get a one-time check of $500, you might spend that differently than if they decide to lower your rate of taxes on every single paycheck that you earn from your job. But generally, we're going to use the tax multiplier to work out kind of on average how the aggregate economy works for tax cuts. Here is your tax multiplier. It is MPC divided by MPS, which is your marginal propensity to consume over save. There is a negative sign here because in order to generate multiple spending, we're going to cut taxes. So this is how much you'd have to reduce taxes by, which is why there's a negative sign there. So we're going to use the same equation as we did for the spending multiplier. Delta Y is the change we'll get to real GDP from the extra spending or multiplied spending. This time I have replaced the spending multiplier with the tax multiplier, and delta AAS is autonomous aggregate spending. So that's the new amount of spending that we get in either consumption or business investment based upon who got their taxes cut. Now you'll notice that MPC divided by MPS doesn't have the same amount as the spending multiplier. So if MPC is 0.5, that means MPS is also 0.5. So we only get a multiplier of 1 this time. If it's 0.75, our multiplier is 3. If it's 0.9, we have a multiplier of 9. So our multiplier numbers are lower for the tax multiplier than they would be for the spending multiplier. Partially, this is because we're just transferring who's spending the money. Instead of you giving the money to the government and having them spend it, they are just transferring it back to you for you to spend it. With the spending multiplier, people are given new money. New money is created. It's money that was not in the economy before, or it is borrowed from a foreign government, or it is created by a central bank. So we're adding more total dollars to the circular flow, which means we're going to get a larger amount of spending. So people spend a bigger percentage of their new money that's given to them than they do a tax cut. And that means that your tax multiplier is always going to be 1 lower than your spending multiplier.